Hello, everybody. My name is Nicole Elliott, and I'm a technical analyst and private investor. And as I'm sure you know, the world is in chaos at the moment. It's very sad and very worrying. This is reflected entirely in all areas of financial markets. This is how it should be. The stock market, as we know, has had a wild ride, all of them, all over the world in the month of March, one of the most catastrophic declines for many indices, either ever or in decades. But my point here is that the average daily move on US indices has been almost 5% a day. I ask you, anything that moves up or down by 5% a day, every day, is that an investment vehicle at all, or is it a casino? What's also been happening is that the bank's need for US dollars has increased significantly. And my first chart is the spread between the yield on a 3-month US Treasury bill versus what a bank would have to pay to borrow 3-month money from another bank, the interbank market, the famous LIBOR. And that's collapsed, or rather, as the Treasury bill yield collapsed to zero or next to zero, the interbank money increased to 120 basis points. So the spread between the two is 120 basis points. That is infinitely more than the next to nothing it was during February this year, and is the highest spread, the most expensive money the banks have had to pay since 2009. There's a shortage of cash. We know that the Fed has been pumping money every other day into the system since mid-September. And over the weekend of the 22nd of March, it managed to shovel a grand $2.2 trillion into the market. That is more than President Trump's bailout package for the coronavirus problems. My second chart is also interest rate one. It's the yield on 10-year Italian bonds. It's a weekly chart, and you can see they had been yielding about 80 basis points. Now that's an awful lot more because German equivalent bond, 10-year bond, was yielding minus 80 basis points. So you can see that the Italian government has to pay an awful lot more than the German one does to borrow money. Then, in an off-the-cuff comment, Christine Lagarde, head of the European Central Bank, said it wasn't her bank's responsibility as lender of last resort to monitor the spread between the credit rating, not the credit ratings, but the credit cost between the different sovereign debts. At this point, everyone suddenly panicked, and you can see that the yield on the Italian BTP chart there, it soars up to 3%. I mean, that's basically, it's tripled on one stupid, ill-thought-through comment. It is going to cost at least 750 billion euros to fix this problem. If it's fixed at all, we don't know. But 750 has been set aside. And it's extraordinary how suddenly all these governments and politicians and central bankers have found billions and trillions to help out in economic situations. And my final chart is that of the US dollar index. And you can see, it's a monthly chart, and you can see that during the month of March, it ranged by nearly 9%. Some currencies have fared even worse. Mexico, Brazil, Norway, and Russia all have seen their currencies collapse by a third this year. This is too expensive. An implied volatility of over 50% is ridiculous pricing, and it's unaffordable. So keep your powder dry and keep safe.